Foreign exchange trading, often referred to as the Forex market, currency trading, and spot Forex, is by far the largest and most liquid market in the world, with an estimated daily trading volume of over $1.9 trillion. That's roughly 80 times the level of turnover in the New York Stock Exchange. Size definitely matters here. The bigger the market, the more liquidity there is, and that ultimately results in better execution for you. Also, because the Forex is a multi-trillion-dollar market, no single entity or group can easily manipulate the market. Add to that just some of the other benefits of trading the Forex market, such as commission-free trading, 24-hour market liquidity, the ability to choose your own trading hours, being able to find profitable trades in both rising and falling markets, execution quality and speed, and better leverage. Over the next couple of minutes, you will learn the basics of speculative online Forex trading, get familiar with market terminology, understand how practical Forex is to trade, learn how to set up your own demo trading account to practice trading and become a successful Forex trader. Forex trading has a very rich history that goes back to the earliest systems of barter and trade. The reasons many of you have only recently heard about the Forex market is because up until recently, Forex trading was reserved only for wealthy individuals, large corporations, and banks. With advances in technology and the rise of the internet, that has all changed, and retail traders like yourself can quickly set up a free practice trading account in minutes, or even begin trading a live account. Before we get started, let's introduce some common Forex terminology which will help you through this video as well as throughout your Forex trading future. Bid price, the price that you can sell a currency pair to the dealer. Ask price, the price that you can buy a currency pair from the dealer. Liquidity, the ability or ease of buying or selling an instrument, the number of buyers and sellers in a market. Long, buying a currency pair. Short, selling a currency pair. Pip, the fifth significant digit in the quote. It is the smallest unit that a price can change. People from all walks of life can trade Forex. White-collar workers, blue-collar workers, executives, housewives, even students. Trading may be intimidating to some, but anyone that has traveled to another country is already familiar with the concept of Forex trading on a smaller scale. When you visit a foreign country, chances are that you'll have to exchange your money for the country's local currency. There are vendors at airports and many shops or banks that will provide this service for you. For example's sake, let's assume that you're traveling from the US to Switzerland. You will have to convert your US dollars to Swiss francs. The symbol for this pair is USD/CHF. You will need to look at what the exchange rate for USD/CHF is. There will be two rates shown. One is the bid price and the other the ask price. The bid price is the rate that you can sell your currency to the dealer for. The ask price is the price at which the dealer will sell the currency to you. The current ask price for USD/CHF is 1.1571. The USD is the base currency and the CHF is the counter currency. You must be thinking, what does that mean? It means that $1 equals 1.1571 Swiss francs. In this case, the US dollar is more powerful than the Swiss franc because you get more Swiss francs for each US dollar converted. You will notice that each currency is quoted to 5 significant digits: 1, 1, 5, 7, 1. The last digit is known as the pip, and it is 1/100th of 1 cent. Thus, a movement of 10 pips would change the rate for USD/CHF to 1.1581. A movement of 100 pips would change the rate to 1.1671. If the current rate for USD/CHF is 1.1571 and you think the rate will increase to 1.1671, you are speculating that the USD will buy more CHF in the future, and you would go long dollars and short francs. Conversely, if you felt the US dollar will buy less francs in the future, you would go short US dollars and go long francs. As mentioned earlier, the ability to leverage is a big advantage of the Forex market. We offer leverage of up to 400 to 1. However, it is a double-edged sword and it can magnify both profits and losses. Leverage allows you to control a position larger than one you have deposited capital for. For example, if you have $100 capital and you leverage that 100 to 1, then you have the ability to control a position that has a value of $10,000. If you leverage 200 to 1, then you can open that same $10,000 position for only $50. When trading with us, you can customize the amount of leverage you'd like to use as well as the size of the position you'd like to open. Now that you know a little more about Forex, let's consider a trade idea and place a corresponding trade. Our analysis. As U.S. stock markets fall, foreign investors are more likely to withdraw from U.S. equity investments and seek higher performing economies abroad in which to invest. Money leaving the United States in the form of USD is sold in order to predominantly buy EUR. Thus, we speculate that the value of the EUR will appreciate against the USD. Our trade: buy EUR/USD. In the Forex market, the majority of trading is concentrated in four major currency pairs: the EUR/USD, Euro versus dollar; GBP/USD, Pound versus dollar; USD/JPY, Dollar versus Yen; and the USD/CHF, Dollar versus Swiss franc. This allows Forex traders to focus their research on only four instruments, or even just the EUR/USD, since it is the most widely traded currency pair.